Right now on someone's chart, two candles just printed that look like a clean reversal. One small candle, then one big candle that swallows it whole. It looks strong, it looks like the turn. And the person about to trade it is probably about to lose money. Not because the pattern is fake, it is actually real. It is one of the most trusted reversal signals in all of trading. They're going to lose because they took it in the wrong place. And this is the engulfing candle. On its own, in the middle of a chart, it is almost useless. But in one specific spot, it becomes one of the cleanest entries you can take, small fixed risk and big reward. So let me show you the exact same candle twice. In one place it loses and in the other one it wins. So let me take you to the chart first, then I will explain exactly how it works. Now, before I show you how to use and trade engulfing candles, let's go through all the trades that are currently running and that we actually placed together here on my YouTube channel. Now, we start with the New Zealand dollar. So guys, full transparency, I moved my stop loss now from protecting 1R all the way up here to protect 2Rs. So which is $8,000. 1R here was $4,000 of risk. Now we protect 2Rs, which is $8,000. Our target is still up here. If you want to understand the reasoning behind, I can make a separate video on it. Just let me know in the comment section. Now, let's go to NASDAQ US 100. So this one you see right here, hit the target last night. Here you see that on that arrow. And the place was taken down here. If I go quickly to orders, you see that as well. Here we took double risk, $8,000 per trade because of the high probability. And we booked in 2Rs. So in total, actually 4Rs if you consider 4,000 risk is 1R. So $16,000 of profit here. Now, we have still 4 pending orders, so 3 different trades. 2 on silver. Absolutely everything is still valid here. 2 on silver, $8,000 of risk. So my new risk profile, my new R is going to be $8,000 from now on. So we have still one placed on Aussie dollar and one on platinum. So let's quickly together increase the risk here and add 1 order on Aussie and 1 on platinum. We go back to trading. And we start with platinum. By the way, I'm here on our Campus Fund trading platform, which is TradingView based. You can get instantly funded right away by today, basically. Just check the link in the description. Here we have the 1 order placed, $4,000 of risk. Now, again, I add another order here, create limit order. Now another $4,000. Here we go. Buy, and we have another order here sitting, all right? Because our new risk profile, as I said, our new R is going to be $8,000. Here, because I'm trading a $1 million account, right? Just as you see up here. Now here also in the Aussie dollar, this is kind of close. So here also $4,000 and sell. All right, so now we're going to go through our engulfing patterns. Now I close Campus Fund and I go to TradingView. Now here on news, we do backtesting replay, and I prepared that already just to be like more efficient in our session here. You see here on New Zealand, we look first at bullish engulfing. So let's assume you found here a nice fresh demand zone on the daily chart on the New Zealand dollar. And I'm using here our newly created supply and demand indicators that draws all these supply and demand zones automatically and also can differentiate between fresh and tested. You see here you have a fresh demand zone sitting down here, drop base ready. If you said, like, I don't want to place this trade, maybe for various reasons, maybe the zone is too wide, or you have other concerns, and you're going to wait for a reversal inside that. Or maybe you just plainly forget to place it because you're busy in your job. So let's see what happens and how you could still get in and also get in maybe with a smaller kind of sized zone. Now let me play here. You see, now, boom, we are dropping down and it just hit the zone. And you see what happens. The zone becomes tested immediately. That's our tool, right? So right now, let's say you missed it and there's no chance for you to get in because price hit the zone, barely hit the preferred version, and then started to run out. Now I continue and you see nothing yet, and boom. Now you see here, you had an engulfing candle. So this one is engulfing the previous candle. It means it covers the previous candle. How to actually specify and all the rules around engulfing candles, I show you actually on the slides after we went through all the charts. So what you could do here is the following. Now you trade. I go to my long position tool. So you go on that engulfing candle. You want to trade above the engulfing candle. Here the bullish engulfing that covers the previous, fully, you see, covers the range of the previous candle. And you would put your stop loss below the bullish engulfing and your entry above your bullish engulfing. And then you would just place a target, whether it's like 1 to 3, 1 to 2, whatever you use. And you see here in this case, right after, because it's a confirmation here, a reversal confirmation, you see what happens right after that bullish engulfing, price starts to rally higher. All right, you see that here. And you see that on the way up, it creates even new demand. So here the bullish engulfing works perfectly. And you have to ask yourself, why did it work here perfectly? And you see the zone got way, way smaller compared to if you just had placed this demand. So everything would have been possible here. But here you see the benefit was smaller sized zone. You waited for that confirmation that this demand zone also works, quote unquote confirmation. Price could obviously still go lower, but you see here it works beautifully. Now that's the bullish engulfing. The same thing, and this is now a little bit more advanced, you can do a bearish engulfing candle. Now look at this here. You have a nice here on the euro futures. You have a nice rally, base drop, right? Here also fresh supplies on high quality on the daily. Now again, let's say you don't want to place it just straight away, or you missed the trade, so you wait for kind of confirmation that this zone has enough unfilled institutional sell orders. Now I press play, and you see now it hit the zone and it came down. Now, so far, you see also, you don't have here any reversal candle. So on the daily chart, you cannot go in. And so this is more advanced. What you can do as well, you can, if you want to get into a trade here, you can go to a lower time frame as well and find a reversal on a lower time frame. This works perfectly as well, and this meets the rules also, because what you do is basically you just zoom in and you find a reversal on a smaller time frame. So potentially you got even a smaller zone. So here I prepared it already. You see on the 12 hours, I go to the 12 hours and look what we got here. A picture perfect engulfing candle. That red candle completely covers the previous candle, the complete range. This is really important. And now you could do here the same. You can go to the short position tool, stop, enter below the engulfing candle and stop loss above. And then you could place any target, right? Any technical target. And if I now continue here, see, I press play. It first takes maybe some time. You see, takes some time. It might meander around in that area, but eventually you see that here price will eventually fall. But obviously, it can take some time here always as well, right? So manage it properly. Here you even have a shooting star candle, and we can wait, or we just continue. So it's completely up to you here how you do your trade management. But you see, eventually price is going to drop. Now let's move on, and I want to show you one here where it's completely out of context. Look at this here. You have a nice, from a technical standpoint, if you just look without context, and this is what people do, and that's the biggest mistake. You have here a reversal candle without context. That candle is, that bullish engulfing candle completely covers the previous candle. So it's a textbook reversal candle, a textbook engulfing candle, however, completely wrong context. And if you went long here, you would go long straight into, you see that here, high quality, fresh supply. And you see what happens here. Once you might think, you're right, price is reversed, and then it hits, you see, it hits that supply zone and boom, it collapses and it stops you out, right? So you see, these reversal candles are very powerful, but what is important, they have to be in the right context. All right, now we go on to the slides, and I'll exactly give you the rules how to trade it. So that is the difference you just saw on the chart. One engulfing candle at a zone, one in the middle of nowhere. Same shape, completely different trade. Now let me explain exactly what you saw and how to use it. So what this pattern really is, the one place it works, and how to enter it. And by the end, you will know how to stop taking an engulfing candle in the wrong place. This is lesson 2 in my price action series. So let us get into it. Let us build it from scratch. An engulfing candle is not one candle, it is 2 working together. The first candle goes one way, then a second bigger candle comes in and it goes the other way. Now, here's where I'm stricter than most people teach. And guys, it matters. It is not enough for the second body to just cover the first body. I want that second candle to close past the entire first candle. Take a bullish engulfing, like the one on screen. The green candle has to close above the prior candle's high. The full high. I mean really the full high, wick and all. See it here. Small red candle first. Then a big green candle that closes above the whole red candle, wick included. That is your engulfing candle. And it is telling you something powerful. The buyers did not just edge ahead. They swallowed the entire move and closed on top of it. That is a real takeover. And I will show you the loose version versus my stricter version side by side in a second. But first, here's the part almost everyone gets wrong. Even a perfect engulfing candle like this one is still not a reason to trade, guys. On its own, it means almost nothing. What makes it dangerous, or makes it gold, so to speak, is one thing. And we are building to it, so please stay with me. Okay, quick but important. There are 2 ways people define a real engulfing, and I want you to see both. On the left is the textbook version. Most courses teach this. The second body just has to cover the first body. That is it. Wicks do not matter. And look, that works. But it gives you a lot of signals, and plenty of them are weak. Now look at the right. This is the version I actually trade. I want more proof. I want the green candle to close above the prior candle's high, the whole high, wick and all. And for a bearish engulfing, the red candle has to close below the prior candle's low, the whole low. So why I'm stricter? Because when the close pushes past the entire candle, the takeover is real. The buyers or the sellers did not just win by a hair, they closed the whole range out. And yes, you get a fewer signals this way, obviously, but each one means something. And that fits everything I teach. Fewer trades, cleaner trades. So for the rest of this video, when I say engulfing, I mean this stricter version, the close beyond the prior high or low. 2 shapes, same idea. The bullish engulfing, a small down candle first, then an up candle that closes above the prior candle's high. Buyers just took over, so it points up, it is bullish. Now flip it over. That is the bearish engulfing, a small up candle first, then a down candle that closes below the prior candle's low. Sellers just took over, so it points down. It is bearish. That is it. A bullish engulfing at the bottom after move down, bearish engulfing at the top after move up. But notice something. On their own, sitting in the middle of a chart, they tell you nothing you can trade. So what is the missing piece? What turns them from noise into real signal? That is the next slide, and it is the whole point of this video. Here it is. This is what separates people who make money with engulfing candles from people who keep losing. An engulfing candle only matters at a supply or demand zone. These patterns show up all the time. Open any chart, you will see plenty of them. And almost all of them mean nothing. A bullish engulfing in the middle of nowhere is just noise. What makes it matter is where it shows up. When a bullish engulfing forms right out of a fresh demand zone, that takeover is real. It is a strong sign the demand is doing its job. You're watching buyers defend that exact demand zone. So the rule is simple and it never changes. Zone first, engulfing second. I mark my zone first. Then I wait for the engulfing candle to confirm it. The pattern never leads. It only confirms. Look at the screen, same exact pattern. On top, no zone. It is noise. On the bottom, at demand, now it is a real trade. That one difference, guys, is literally everything. Let us get specific. How do you actually take this trade? We will do demand first with the bullish engulfing. Then we will do the same thing for supply. Price drops into my demand zone. The bullish engulfing prints. A small red candle first, then a big green candle. It closes above the whole red candle, above the prior high. That is my valid engulfing, now my entry. I do not buy right away. I wait. I buy the moment price trades above the high of that engulfing candle. That way, price proves the move. I'm not guessing the bottom, now the stop. This is the first of two ways to do it. The candle stop. I put my stop 33% of the zone size below the engulfing candle's low. So I take the whole zone height. Take 1/3 of it and drop my stop that far below the engulfing low. One thing you must understand. My risk is always the same fixed dollar amount from my trade plan. That never changes, guys. Because risk to reward only works if the risk stays the same. So tighter stop is not less risk. It just means I can take a bigger position for the same risk. And that gives me a higher risk to reward proposition because my target is also fixed. So that is the good part. Tighter stop, higher risk to reward. The bad part is real too. Price can dip just below your stop, take you out, and then turn around and go your way without you. You were right about the zone, directionally speaking, but the tight stop shook you out. That is the trade-off. Same trade here, second way to set the stop. The zone stop. The entry is exactly the same. I buy above the engulfing high, only the stop changes. This time I put it 33% of the zone size below the distal line. The distal line is the far edge of the zone. So now my stop protects the whole zone, not just the candle. The good part, you're much harder to stop out. Price has to break the whole zone first. The bad part, the stop is wider. And for the same fixed risk. A wider stop means a lower risk to reward proposition. Same target, but a longer stop. So here's your choice on the demand side. Same entry, same risk, same target. The only question is the stop. Tight on the candle for a higher risk to reward, but more chance you get shaken out. Or below the distal line to protect the whole zone, but a lower risk to reward ratio. Now, the same two ways, but for supply. This is just the mirror, so it will go fast. Price rallies up into my supply zone, the bearish engulfing prints. A small green candle first, then a big red candle. It closes below the whole green candle, below the prior low. That is my valid engulfing. My entry flipped. I sell the moment price trades below the low of that engulfing candle. First way to set the stop, the candle stop. I put it 33% of the zone size above the engulfing high. Tight on the candle, good part, tighter stop, as you know, higher risk to reward ratio. Same as before. My risk stays fixed, my target is fixed, bad part also flipped. Price can pop just above your stop, take you out, then turn back down and run without you. Same trade-off as the bullish side. Now, just upside down. And the fourth one, supply zone stop. Same entry, I sell below the engulfing low. The stop goes 33% of the zone size above the distal line, the far top edge of the supply zone. So now I protect the whole zone, not just the candle. Good part, much harder to get stopped out. Bad part, wider stop. So for the same fixed risk, a lower risk to reward ratio. So now you have all four. And really, it is one simple idea used four ways. Bullish engulfing in demand, candle stop or zone stop. Bearish engulfing in supply. Candle stop or zone stop. Every time it is the same choice. Tight candle stop for a higher risk to reward ratio, but more chance of a stop out. And or wider zone stop, harder to stop you out, but it pays less. I choose based on how big the zone is and how clean the engulfing candle looks. Okay, that is the four models. So just a couple of minutes ago, you just saw both setups play out on the live charts. Now, two quick things that decide how well these actually work for you. First one, where do you look for these patterns? Simple rule first, look for the engulfing candle on the same time frame as your zone. If you marked your zone on the daily chart, you look for your engulfing on the daily chart. If you marked your zone on the 4 hour, you look for it on the 4 hour, same time frame. That is the default. And it is what most people should do. Now, here's a more advanced move. You can refine your entry. I showed you that method as well. You mark the zone on the higher time frame, like the daily, but then you drop down one time frame to 4 hour, for instance, or how I showed you on the 12 hour, and you look for your engulfing there. Why would you do that again? Because a smaller pattern on a lower time frame gives you a tighter entry, and a tighter entry means a higher risk to reward. Again, there's a catch. What is the catch? With entry model 1, the candle stop, that tighter stop also means you get stopped out more often, and it works all the way down. Daily refine on the 4 hour zone refine on the 60-minute. Same idea each time. If you're newer, just keep it simple, guys, and match the time frames. The refinement is there for you when you're ready. And the last big thing, and honestly maybe the most important, there's no right or wrong model here. People always ask me which one is best. It depends on you, your market and your style, so do not guess, test it. Here's how. Step 1, pick one model, just one, and use it on your next 10 trades. Do not switch it in the middle. Step 2, log every trade, write it down. Your entry, your stop, the result, and how it felt. Do screenshots, everything, the whole 9 yards. Be honest with yourself. Step 3, after 10 trades, then you look at the results. Not after 2, not after a bad one. After 10, guys, then you decide. Keep it, change something small, or try the other model. This is how real traders get better. They do not jump around. They test one thing, they journal it properly, and they let the numbers tell them what works. Not every engulfing candle at a zone is the same. So here's how I tell a good one from a great one. 4 things. 1, a strong close beyond. Remember, my rule is the close has to clear the prior high or low. The further past it closes, the better. A close that pushes well beyond beats one that just barely clears it. 2, the time frame matters. An engulfing on the 4 hour or the daily is much stronger than on the 5 minute. 3, a fresh zone. The first touch is worth more than a zone price has already hit many times. And 4, the big one. My bias from step 1 agrees with the trade. My cycles, my evaluation models, CUT, everything all pointing the same way as the pattern. When the bias, the zone, and the engulfing all line up, that is your best setup. Those are the ones worth waiting for. One honest thing before we finish. Engulfing candles fail. They fail often, right? And I want to be straight with you about that. The edge is not a higher win rate. The edge is this. The candle and the zone give you a clear place to be wrong with the same small risk every single time. So your risk to reward stays in control. Think of it like this. The engulfing gives me a clean place to be wrong, not a promise to be right. Quick recap. An engulfing is 2 candles, the second closest past the whole first candle. Above the prior high for bullish, below the prior low for bearish. Only traded at a zone. The location is everything, guys. Bullish for demand, bearish for supply. Enter above the engulfing high or below the engulfing low and set your stop one of 2 ways. Tie it on a candle for a higher risk to reward or below the distal line to protect the whole zone. Match your time frames and remember, pick one model and test it over 10 trades before you change anything. And it is strongest when your step 1 bias agrees.